Calcutta. We used to offer the one-year executive programs at that point of time. Full-time MBA started in 1980s, and we have 37 batches graduating today. That's one. So we offer MBA, PGDM, and we also have a one-year weekend program for the data science, as well as we offer a PhD program as well. Right, so we used to be a teaching school. Last 2-3 years, thanks to our director, right, so we are converting into a research school as well in terms of the publications and citation. I'd like to showcase the fact that as a director is listed in top 2% of scientists related in Stanford University. In fact, 2 of our faculty members are there. And former director of presentation sir is also BPCL and some fintech companies as well. So welcome sir. We are he's my batchmate IIT Madras, Dr. Naveen. He's a finance area chair. You know that around 3,900 business schools are his entry. You can safely say that Type 2 is trying to aspire to be in the top 50. So I request Naveen sir to lead us in the interactive session. They are the first MBA and second MBA students speaking
with McKinsey for almost 20 years before joining TVS Capital Funds. So I would just like to give a brief introduction about TVS Capital Funds before I take the session along. So TVS Capital Funds founded by Shri in 2007, and this is basically to empower India's next gen entrepreneurs. They consist of a very good team. I was just going through their website, seasoned professional investment team with a lot of high profile people from across sectors, and it has, they usually fund early growth stage to late growth stage and also before IPO, right? Just pre-IPO stage. Right, so they were actually heavily involved in 3 funds. That's what I saw on the website. So it is TSGF3 funds. They are currently working on TSGF3. That's called TVS Shri Growth Fund. Just to give a brief intro, TVS Capital Funds, the main sponsors are TVS and Shri.
Actually, no sir. So essentially we have the asset management company which is called TVS Capital Funds.
Okay.
That is what Gopal founded and we are all part of.
Okay.
Then the Shri Group, which is Shri R. Tyagarajan is founded. Each of the funds is a standalone entity that is jointly sponsored by TVS Capital Funds and Shri. So there's an AMC and then there's a fund. This AMC is running the fund, but it has 2 sponsors, TVS Capital and
Shri. Okay. So the current sector focuses on 3 major areas: financial services, B2B services, and niche consumer area. Right, so I think TVS Capital Fund investment, as I said, 3 funds held: TSGF 1A, TSGF 1B, and TSGF 3. I'm not sure whether 1A and 1B are still active.
Basically, no 1 and 2. They are both exited.
They are both exited. Okay. Just would like to give some brief intro about the companies that they have invested. So TSGF 1A, they are invested in DCB Bank, Chili's, RBL Bank, Papa John's. I think most of you must be familiar with that pizza company. Right, and DTS, MedPlus, TVS Supply Chain Solutions, Landmark, I think many of you must be aware about it. It's the bookstore at Spencer's and Numambakam. It's owned by the Tatas. Owned by the Tatas, right? And Regent and Leonard. TSGF 1B, Suryodaya, NSC, CUB, City Union Bank, IEX, that Indian Exchange, Energy Exchange, I believe, right? Nika, again, well-known company, RBL Bank, and KVB. And the current fund which is very active is called TSGF3. The current companies that they have invested is Digit, Insurance Deco, UB, Vibrati Capital, PhonePe, Sarvagram, Incref, and 5-Star Business Financial Limited. Right, so they are active. And the current fund has a commitment of around 1,900 crores. Right, so that's where he's coming from. Right, so I'd like to set the ball rolling. So, just few questions to begin with. What are these funds basically invested? In the sense that you had 1A and 1B, right? I know that they are completely exited, right? So, what is the average rate of return that these funds? And do you have any sectoral preferences? I know it's across sectors. What is the average CAGR, if I can?
Sure. So typically when we look at funds, we look at IRR, internal rate of return, and we look at multiple on invested capital. Those are the 2 metrics you look at. And the metric in a sense is whether, and this is true for any investment, right? If I put an investment in land or in gold or in the public market, each of these has a very different risk return profile. Each of these has a different liquidity and term, right, in terms of how long. The only way to look at it is a comparable is usually the IRR, return on rate of return. And because this is a finance class, I can say all this quite easily and not have to explain it. So the IRR for our fund 2 was about 17%. But in fund parlance, there is a gross, which is typically every fund like ours, like a private equity fund, has two commercial components. There's a fee component, which is an annual asset manager fees that is paid. And then there is a carry component, which is on the profit that is made at the end, the asset manager gets a share. So
that's where Balaji is more interested. Just on the lighter side, because generally, as I keep saying, more than the component, most of the VCs and PEs are more interested in that profit sharing at the end of the.
In fact, the fee part is quite small, and it is really kind of think of it as working capital. End of the day, it's what keeps the lights burning and the lights on and all that, and it just keeps us going. But the real reason that we are in it is for the carry. But it's also the right way to keep people incentivized. Imagine I take your money and you never see me again. And I essentially said, I'll go do something in my life. Then you'll say, what is going on? The way that I'm incentivized is because I have skin in the game. Because that carry component is what I have to get at the end. And I typically get it only when money is made. Of that share, only are you going to give me something. So essentially in private equity investing, a team has to stay for 10, 12 years to make sure investments happen. There's an investing period and then there's a harvesting period. So typically over the first 4-5 years we are making investments, and each of those investments has to last say 5-6 years. So that last investment you make in year 4 will only come out in year 10. So over a 10-year period I have to make sure that this fund runs well. So the way that the structure is set up is to incentivize people to stay the full course. The other way that it's structured is that you only make money when everyone makes money. So for example, the first company I did amazingly. Amazing. I've sold everything and I made 10x the profit. But if every other company after that loses, you still lose. So it's not at the end of every investment. It's usually at the end of the full cycle. They have to. So at some level, it allows for incentive alignment. But your original question, our return net of everything, including fees and carry and so on, but pre-tax, which is what for net IRR, was about 15.1% in Fund 2. Okay. Currently, we are in the middle of Fund 3, and we are at what we call Fund IRR. I'll explain that in a second why I'm saying a new term. It's all very complicated, but it's a Fund IRR of about 23%. The reason it's called Fund IRR is because we have taken fees out, but we have not taken out carry. And we have not taken out carry because we are in the middle of the fund. I can only take carry when I've gone through the full life. So we have an estimate of what that will be end of life. It will be around 20% is what we think. So we can take, for the purpose of this discussion, we can take our net IRR is about 20%.
So excellent. I mean, these are all very confidential data, right? They're not easily available from the open source. Thank you very much for sharing that.
Sure.
And I mean, the general exit mode is kind of through the IPO, right? Or selling it to the other investors. Or what kind of exit mode you generally have?
So for us, as a growth equity investor, we typically are investing in companies that we believe can scale and we provide growth capital. So the types of companies we invest in, typically, we like to see an IPO exit. The reason I say we like to see an IPO exit is kind of man proposes, God disposes kind of thing. That all kinds of things happen in the private company space. You invest with a certain mindset, you have some plans, and then life happens. So far, I think our companies have done reasonably well and are on track for the IPO. We also sometimes invest in companies where our exit mode, even as we write the thesis, is a secondary exit, which means it may not be publicly listed, but potentially either a strategic investor could buy it out or another PE fund could buy it out. So what I mean by a strategic investor is, or a PE fund, we invested in a company called Leap. This is all public domain. We invested in a company called Leap. They do asset management, basically pooled asset management. They make large crates, wooden crates that are then leased out. So if you're a soft drink manufacturer, you'll get our crates, you'll pay us a lease. very complex for you to manage, but we'll manage on your behalf. So and it's a very interesting business because usually only 2 or 3 players exist in any market. So we invested in this company, and last year KKR, a large private equity, bought out our interest.
Travis Goldberg and Roberts. Okay. Okay.
So they
So
bought
are they Kolkata Knight Riders?
no.
It's a KKR, it's one of the biggest players in private. I mean, just for the
Yeah,
audience, I mean,
Well,
just pay a lot of attention because each meaning, I mean, each word will have in-depth meaning, right? Maybe you'll have to Google in-depth and find out. So, I mean, you can just talk to us in terms of layman, right? So, many of our students just getting initiated.
Absolutely, yes. I should slow down.
Yeah, we don't have a private equity course as such.
So it's a large private equity firm, as you say. It's a global private equity firm that's now has had an India office for a while, and they have bought out this asset. So they bought out our interest in the asset. So that's an example of someone who made a purchase pre-IPO. But we have other assets in our portfolio which we also think will go through a mode like that.
Okay. So again, just for the audience sake, can you just brief us about what do we mean by pre-money valuation, post-money valuation from a layman's perspective, so that I think the audience we can get up to speed.
Yeah, absolutely happy to. I mean, I would say that this is an industry I'm still new to, but I can explain these terms. It's no issue, and happy to kind of go into that also. So typically, when you are investing in a company as a venture company, obviously there is no market made for it. Unlike the public market, right, where you have a market, you know what the price is, and there's some market determined price. And I'm sure you've all done. There's a discounted cash flow method, there's a comparables method. There's some way of saying this is what this company is worth, and there is a market price for it. You may have a different view, and therefore you will buy or not buy, but that's what the market says. In private companies, fortunately or unfortunately, it's ascribed value because there is a book value, but what the real market value, there is no market which is made to a certain value. So let's say I want to buy into your company and I want to buy 100 shares of this company. The only way I can do that is if we both agree on what those 100 shares are worth, right? So that's the conversation called pre-money valuation. You have to tell me, so I'm buying from you, you tell me how much you think your company is worth. And we can agree on what the method of valuation is, but you're telling me what it is. I will find my own method of valuing it, and then we both agree on somewhere in the middle, usually, and you think it's worth whatever, 5 crores, I think it's worth 3 crores, we might agree on 3.5 crores. That is what the company is worth. Now I want to infuse, let's say I want to put in 1.5 crores. Why does this person need 1.5 crores? They have some things to do with it. They want to open a new market, they want to invest in R&D, whatever. That 1.5 crores now gets added to the 3.5 crores to become, I'm just testing all of your things. So 5 crores, right? So now the value of the company is 5 crores. That's all pre-money and post-money valuations. Pre-money valuation is what the company is worth. Post-money valuation adds what is invested in that company, and that is now the new value of this company. Now, if you want to know what that is worth in terms of your share price, you can do that also, because 3.5 crores has a certain number of shares already. Your 1.5 crores, they will issue, if it's primary issuance, they'll issue new shares. Together that will add up, and that's, you divide that by 5 crores by that, that becomes essentially the value of the company. So that's all pre-money and post-money valuation is. It's not more complicated than that. What we agree on as value. So typically as an investor, when we invest in a company, and we are evaluating the company, we evaluate the company at whatever the pre-money valuation is. And that's based on, okay, this is what is there. Then I say, okay, if I put in 100 crores, what is my share of the new company? It's 100 divided by 100 plus V, whatever the value is. That's my share of the company, whatever X percent.
Okay, thank you. I think he has explained it in very nice terms. I think the valuation is just not going to kind of exponentially grow because it depends on the market valuation also. Byju's is a classic example where the valuation in fact has come down big time, right? So it's not only one side, it can also happen the other way around, right? So,
no, for sure. In fact, it happens it happens in public markets also. I mean, I don't know if a lot of you track stocks or you invest in stocks yourselves, but prices fluctuate on a daily basis. They fluctuate on a weekly basis. They fluctuate on a, there are any big time variation you take, there will be fluctuation. Right? So prices fluctuate, but because it's a public market, you're able to see the data and you can reflect on it. And whether there is an external shock, whether there's an internal shock, whether there's an internal surprise, upside, all kinds of things can happen. In the private market, unfortunately, it's not transparent, it's a bit opaque. And the mark to market only happens at certain times. What is mark to market meaning? What is this worth now? Suppose you look at me today and say, you have all these companies, tell me what is 5-star finance worth. I can tell you. Why?
It's public.
Because it's publicly listed. I can look up and I can say, okay, this many shares I have multiplied by price and I can tell you what it is. But I have another company in my portfolio called GoDigit. I can't tell you what the valuation is because it's not listed. So you ask me what the value is today, I'll tell you what the value was at the last time it was valued. Where somebody put a value to it. They will say, okay, they are an insurance company, the gross written premium that they have in their book is X. If I look at comparable companies, this is what it should be worth. So that's how they will assign value, but there is no real way to know until they actually come on the public market. So the challenge for private companies is, how do you know what their value is? And that's why it takes more time and effort to understand that. It's not as straightforward as in the public market. And like you gave examples, there are many examples of companies that have unfortunately valued at some insane number that then became sane and was not good anymore.
Correct. And by the way, a lot of our students have taken financial derivatives, SAPM, market microstructure,
Right.
and many of them actually trade. So they're quite familiar with stock market. So I think it's a good one. So it's, in fact, again, I would like to thank Mr. Naveen for coming handling this program, because as I keep repeating, you don't really get to interact with such a high-profile person, right? So yeah, and I just saw in your website, the investment philosophy is broadly based on certain factors, idea-based investing, top founder quality, obviously it's based on the management that the companies have, and they have something called AAA, it stands for ambition, ability to attract talent, and ability to execute. Right? And sectoral focus, obviously any investment is based on the sectoral focus. And multi-decadal business attractiveness. They just ensure that the business is going to survive for the decades to come. I was more interested in this particular thing called proprietary 1080 model to develop in-depth insights.
Sure.
Can you just throw some insights? I know it's a proprietary model.
No, it's fine. It's not. It's more marketing than it's. But I'll tell you what it is. You'll realize it's not about marketing. It's fine. But it's very important for us. I'll tell you why it's important for us also. So we invest in a space called growth equity. So growth equity, typically you take a share of a company that's it's a bit further than venture, and they have achieved something. It's not, it's not just an idea and you're saying, okay, give me seed capital. The idea has gone out into the market, they've found some product market fit, they have developed some revenues, and now they want to scale. That's typically when we come in. When we come in backing the management team. Like we said, we look for a AAA founder, that's the whole conversation itself. But we really want to back the founders. Unlike, for example, in buyouts. So when I do buyouts, I would buy a controlling share. And then I have levers available to me around changing management, etc. Here, that's not a lever that I'm even looking for. I'm essentially backing a management team with capital and expertise to scale. So the big challenge there is, how do I really know this management team is capable, but also has integrity? So it's part of it is capability, part of it is integrity. And part of it is, you're capable for this, but are you capable for that? Which may not be the same case, right? If I had 1,000 crores today, 1,000 crores of revenue, and essentially we're underwriting a case that you will be 5,000 crores of revenue in 4-5 years, which is often the growth trajectory of these companies. It's not the same organization. For example, you might be in 15 markets tomorrow versus say 1 or 2 markets today. You might be in very different customer segments. You might even be international. Your R&D, so many ways in which the company itself changes. So are you able to do that? So typically the way we are able to assess that, our diligence on this based on our lessons in the past, including mistakes, has been to go even deeper into this and test very widely. That's why we call it 1080. So 1080, the first is the 360 of the team itself. So imagine that the 4 or 5 of us are in the team, we would have one of our experts go in and interview each person individually and understand where are you at, what's happening, how long are you here, how long are you going to be. And then they'll say the best things that they can. But eventually you get a picture of how the place runs. For example, we have walked away from situations where it's a very strongly CEO-led in a way that is not conducive to long-term success. They're operating under stress and are able to make things happen, but we are not sure if this can continue over a 5-6 year period because we are underwriting a multi-decadal business. The reason we are underwriting a multi-decadal business is if I want to exit in 6 to 8 years, the next person who's coming in should at least see 10 to 15 years beyond. So if that person has to see 10 to 15 years beyond, I have to see now whether this is a 20-year life. Right? So for example, there are businesses that or whole spaces we have stayed out of because we can't see 20-year life. So that's a multi-decadal business plan. But for that to happen, 6 to 8 years, I need strong management team. That's a AAA founder business. For AAA founder, I have this 1080. So the first 360 is this group. Then the second 360 is we speak to employees and customers. And especially, for example, in a business-to-business context, we go and speak to the channel partner. We will go and speak to a customer, the person not necessarily at the top, not necessarily the owner of the customer, but the person who's interacting with them on an app. How good are they in fulfilling? What is the customer experience like? The third 360, we go into our ecosystem. So our network, and we say, does anybody know this company that can give us a real view of what's happening? And we put all this data together. So typically, in a company diligence, we would have done 45 to 50 conversations. And when we put all that together, you get a real picture of how this place runs. And that's because we want a AAA founding team. That's because we want multi-decadal business. So I hope that's how we kind of think about it.
Yeah, I think it broadly summarizes 360 to 3.
Correct.
1080. So I'll open it for the audience for discussion. Any questions? In fact, I had the privilege of meeting Gopal Srinivasan some 12 years back. I think your office is in Nagaram.
It used to be. Now we're in Arikod, but not very far from there. But it used to be off TTK.
Somewhere behind the bridge it used to.
Correct. Somewhere under the bridge. But now we have moved offices. We have our own building.
So, yeah.
I'm Ketan from Second Studio. So, considering the criteria which you mentioned, kind of interesting because there are several sectors that you invested, like pharmaceuticals, edutech, like that. Did you specifically miss any sector because you find it not going beyond 20 years? That's one of my questions. Thank you.
I don't think, given India's growth story, India will grow in many different ways. Consumption will grow, manufacturing will grow, services will grow. So we don't see spaces that will not grow. We think there are spaces that are better suited for our type of investing, growth equity investing. And we think there are spaces that we are better suited for, given what we know and understand well. So for example, manufacturing versus services. We have by and large gone into services. Services are more easy to scale. Over a 6 to 7 year investing period, it's more likely to get a return in services than manufacturing. Manufacturing tends to be a somewhat longer term play in terms of how it plays out. And for example, it will take you 2 to 3 years to probably set the thing up, then for it to deliver returns. And so typically we find that buyouts are more suited for manufacturing, especially in private equity. That's where typically we are seeing money being made. Growth equity is much harder. So that's one choice. The second choice is a conscious choice that we have made to do more in financial services. The reason we do that is because we really think we understand that space well. We understand the regulatory environment there. The odds of getting a successful business in financial services are higher because there's an automatic barrier to entry. You can't just say tomorrow I'll start an NBFC. You need a license. The licensor will keep checking on you. So even though there's a lot of stuff that happens in the sector, by and large there's less that will happen there because of the regulatory barriers. Versus saying consumer. Anybody can start a consumer business. So the odds of a consumer company getting to IPO are less than 1%. Odds of a financial services company that gets formed to get to IPO is more than 10%. So for us, financial services makes sense. So I hope that answers the question. I think that every sector is worth investing in. I think asset class, which type of investor you are, makes a big difference in where you invest or which sector you choose. So we have chosen financial services and tech as the two spaces more amenable to growth equity and more amenable to us. We understand these spaces somehow.
Good afternoon, sir. Myself Kishore, second AMB. So my question is that micro cap stock or a penny stock. So as a retail investor, can use those due diligence to make money?
It's an interesting question. But if you, as a thought experiment, you said, we're both sitting outside and having a cup of tea, and you said, what do you think? I would say that I think it's important, very important, especially in micro small cap space, because anything can happen there, as you know. So much like in private equity investing, the founding team's quality, integrity matters a lot. So as much information as you can dig up about the people behind a company, you want to get it. The only question is, do you have access to really high quality sources of data? That's what you need, right? Are you able to speak to all their suppliers and their customers? Are you able to talk to people who will give you the real dirt on what is happening? Those are the questions that you have to ask yourself. Will you have access to the data? If you have access to data, you should use it. The way I would frame it is, do not make an investment without at least having that access, because basing it off some technical data alone in that particular space that you mentioned is very risky, as you know.
My question is regarding the startup ecosystem. So nowadays in India, the startup ecosystem is boosting a lot. But still, if we dig deep, most of the companies which are valued higher, like Flipkart, are still constantly making losses. Do they still have intrinsic potential, or I would like to hear your take on it?
Partly because we don't understand some of this. We don't understand the types of investments people are making to build the franchise. But I'll give you a counterpoint by looking at what's happened in quick commerce. Now, we still don't know how this quick commerce story is going to play out fully. But you can imagine 2 years ago, everyone said, who needs a 15-minute delivery? I was one of those people, because I don't need a 15-minute delivery. But I remember last year going to Bangalore. So I live in Chennai, but I went to Bangalore to a relative's house. And he never goes to the shop anymore. Everything is a 15-minute delivery. I said, oh my God. Like, customer behavior is fundamentally changing. And you can see that playing out. You can also see that several of them, under pressure from the public market, are beginning to do more things around profitability. That has also bled into the private market. So over the last 12-18 months, you will hear and see a lot more private companies are having to respond with, we have to be profitable, at least at the unit economics level. So at the end of the day, at the unit economics level, you should be able to make money, and then you can choose to invest. So overall, it will look red, but I need to make sure that this is still making money. If this itself is not making money, then you're just throwing, good money after bad and hoping that something magic will happen. And customers at the end of the day are not super loyal. You give them something better, they will move, right? So I think the way I think about this is, I think it makes sense in certain sectors, in certain places. But the fundamentals, the business fundamentals are too hard to ignore. For every quick commerce thing that is now somehow coming out to be a win, I've seen too many things that have been mirages, and everybody's selling the same thing. Oh wow, it's amazing. And the more they say it, it almost becomes a fact, but it's not. Business fundamentals don't change. I need to make ROCE. If I'm not able to see a path to return on capital employed at a certain level that is above my weighted average cost of capital significantly to allow for risk, what am I doing, right? So I'm probably, I'm not the expert in consumers for sure where a lot of this is happening. But for me, the way I think about a business is at the core unit economics level, are you making money? And then how much are you choosing to invest? If you're choosing to invest ahead of the curve, to get ahead of competition, that's why you're on the red, fine. And we have companies like that, we understand why they're doing it, no problem. But if your fundamental product itself is losing money at that level, and you have no line of sight to making money. So I'll give you an example. There is a company that earlier, the EdTech company we spoke about, acquired. I remember speaking to the founder, who's now moved on. But they were essentially getting a lot of traffic through Google Ads. So there was no way, their customer acquisition cost was so high, there was no way they were ever making money. So it was, you can just say I've got X customers and I buy eyeballs and all, but you're not going to make money ever. The moment you try to become profitable, then market share will go like that. What business is that? I mean, it makes no sense. At least that's my view. Eventually, there has to be a path to profitability.
Thank you, sir.
Good afternoon, sir. This is Naveen Unni question with the previous answer. If now the current startup companies are more into revenues than profit, why they are more, like traditional companies are looking on profit, but the startup companies are looking on revenue basis. So what makes them to move towards revenue? And my second question is, why the private equity firms move out of the companies they invested before the IPO? Like, why they not, if the company has growth trajectory, why they stay?
If you don't make profit, you focus on revenue. It's not rocket science. I'm genuinely saying. If you make money, everybody wants to say we make 20% profit. Boss, life is very easy. So your return on capital looks very good and so on. If you don't make profit yet, you have to focus on another metric. So that metric is revenue. If you say, sir, I don't have profit, but I have revenue.
Making them more, the accumulated loss is getting high because of it.
All I'm saying is, see, I'm sorry, I'm giving a flippant answer, but there is a truth under that. What I mean is, eventually all companies want to give return on capital. That's what matters, right? I put capital in that business, that capital should return. That's at the heart of it. But sometimes it takes time to get there. I have costs and expenses that are ahead of when the revenue will come in. So to that end, at least I want to show you, as let's say you're my investor, I want to show you, listen, I'm getting there, but look at this growth. Because once the growth gets to a certain amount, my fixed expenses will not grow that far. It will get amortized. My variable is okay. Therefore, I will start making money at some point. So the conversation they're having with you is not to say, look at my revenues. It's saying, look at my growth, and eventually the growth will account for my expenses and we will become profitable. They're not having the full conversation with you. But if I'm an investor, then that's what they're really telling me. So what you're seeing in the press is saying growth of X and revenue of Y. But the underlying message is, we will grow faster than our expenses can catch up, and therefore we will become profitable. So what they're saying with revenue is actually, we will become profitable in the future. Whether it's true or not, you have to examine how they're doing business to understand that, but that's the part of the message. Your second question of why PE firms exit before IPO, it is usually one of three reasons. The first reason, and often a very practical reason, is you're at the end of life of your fund. So typically, private equity funds are closed-ended funds. Closed-ended fund meaning I have a start date and usually I have an end date. And the end date I have to give you money back, so I have to liquidate the assets. If I can't liquidate the assets, I have to give you back a part share of this company, and nobody wants that. It's a private company. I asked you as the manager to manage it. You don't like that. Or I have to kick it forward into another fund called a continuity fund. All that is not very good practice. So then the next time I go for fundraise, they won't give me money. So to do that, I have to exit. Even if I don't like it, I have to potentially exit. That's the first reason. The second reason is I get a very good offer. And that offer meets my threshold of IRR. So that could be, whether it's an IPO or not, what I care about is return. If my asset will give me a 40% return, IRR, I'm okay, right? Whether it's IPO or not. And that's good enough, and I'm happy with it. The third is that I don't believe in the future of this company. So again, from the outside it will look to you as pre-IPO, why did you do it? But I may not believe in the future of this company. That company may still surprise you. The market may surprise you in what you get. But I, for example, have a very dim view of what this IPO will give me. And there is one Bakra there who will pay me a better price for this. Please, go for it. So eventually, as an asset manager, I have to balance these two things all the time. At one end, my most important clients, my LPs, who are giving me money that I am managing for, then I have to give them a return. End of the day, they are my karta. The other, I have these founders who have trusted me with their kind of company and allowed me in to help them. I'm constantly balancing these two forces and trying to do the right thing by both of them.
So that's a very good question. I mean, very good, because other things. We're just happy to be IRR.
In our business,
Sir, welcome to TSM. My name is Ved Srinivas. I have a question. First of all, you said there is an entry barrier to the finance and tech companies. So you tend to invest in that.
finance, not so much tech.
Okay, finance. Maybe an NBFC, or if I can extend to banking. SCB, Scheduled Commercial Bank. Just today I read the news about the Kotak Mahindra Bank, and you see how the markets have reacted. So, on the one hand, you take the regulatory body's license as something of an asset and advantage, but on the other hand, just one, ban or something brings down 12%. Kotak Mahindra, I was shocked today. It was the darling of Dalal Street, if I can say, if not Wall Street, that Kotak Mahindra Bank. And the second thing is that what are your views on public sector undertakings getting listed? Like recently we saw in the case of IREDA, IREDA, crazy evaluations, 30 rupees IPO became 200 and then now.
Right.
So the two questions are in the form. So PSU.
What is risk for some is opportunity for others. That's true in all facts of life. That's where arbitrage really is. Information arbitrage, you understand something better than someone else. So you're absolutely right that a highly regulated space, which has multiple regulators, financial services primarily has three, it has RBI, SEBI and Sectoral, is a complicated space because the government is, for a country like ours, the government always has to intervene to kind of create its broader goals of uplifting people out of poverty and so on. So it is not a straightforward answer, and it's always easy to say the regulator, but the reality is it's a tough space to manage. Political compulsions and all kinds of things. So I always have a lot of empathy for the regulator and doing all they're doing. The point is that if you do understand that space well, you can do better than most people. And what that means is understanding how they're thinking. What is the thought behind the thought? So for example, in insurance there is this idea of Bima Sugam. The government wants to disintermediate the insurance industry. There's a lot of rampant mis-selling. I don't want these agents. Because insurance is a push product. You have to constantly come to get it. So they can mis-sell. So they want to remove this. But our country, how do you disintermediate it? People are still figuring out, they're so underinsured as a country. So whether we like it or not, we have to increase the penetration of insurance. And physical is the only way to go. Now they have this noble intent. This is the ground reality. Now they have to try to bridge the two. So you have to keep understanding, okay, that is the thought, that's what they're trying to do, noble intention. This is the ground reality. And so, for example, we have an investment in a company called Insurance Depot. It has one of the largest agent networks in the country, about 120,000 agents. Now, if I said insurance regulator wants to ban intermediation, remove all distributors, then I should exit. I shouldn't have invested in this company in the first place. But because we understand the intent and we understand the reality, we are able to make an investment knowing it's a 15 to 20 year play. That's what I mean. So it's not at the highest level regulator does this not, but being really able to go behind and understand why they're trying to do it. For example, you would have read in that article, wherever you read it, that they've been giving warnings for 2 years.
Yeah.
There is non-compliance.
Yeah.
It's the same thing at Paytm also, right? So the regulator is not, it comes across as one time, but usually there's often many interventions that are happening. And so if you have the ability to understand that cycle and you're in there, then you know this is coming. For us as lay people who are reading this, we're like, oh wow, it happened. But sure they would have seen it, right?
No, lot of associated news came with today, like you said, 2 years back.
Correct. But that all happened, so that you're able to track. Having said that, there's always risk, right? In consumer, the risk is there's market risk, there's new technology, there's all kinds of risk. It's a very low barrier to entry. So another competitor, you're selling lipstick, that person is also selling lipstick. So okay, right? So there's other types of risks. So the question is, which risks are you comfortable and you feel you have an edge? In this space, we feel we have an edge. To your second question, I really don't have an answer over here. It's not my area of expertise, and I just don't know. I wish I had a better answer. I don't. I mean, this year you'll say Israel is happening. Next year something else will happen. No, I mean, this is life. We just have to take it that we are living in a very complex, interconnected global ecosystem. We are going to get hit. The only question is which angle it will come from and whether you can see it to some extent or not. So there is no real way to know this. That's the reality, right? I think the one thing that we're constantly looking for is what is a short-term versus a long-term trend. That is very important to fully understand. So for example, so let's work through that, okay? 2 years ago when COVID hit, a lot of global supply chains, 3 years ago, somewhere around there, a lot of global supply chains were hit, right? And the moment the global supply chains were hit, there were ripple effects. You were not able to get things and so on. Then you had domestic push on manufacturing, PLI and so on. Then you had China being excluded and China-US tension and so on. So you have multiple different factors playing into an overall trend of more nearshoring, more onshoring of manufacturing. How much of that is long-term versus how much of that can go away like that? That analysis is important. Because it looks like, oh, China plus one, therefore everyone will come and manufacture. But when you really pause and say, which of these factors are real long-term? For example, is the cost advantage that China has, is that going away? The answer is no. India is still a very expensive place to manufacture. India still has a lot of red tape. Even with the PLI benefit, it's not. Okay. Then does it make sense in certain sectors? There it makes sense. It makes certain sense in sectors A, B, C. Why does it make sense? And will this be a 10, 15, 20 year trend? That deeper analysis is where it goes beyond the headlines to say what does it really mean and what impact is there. The rest, you just have to hope that cycles work. The reality is, looking at a ticker tape every day makes no damn difference to anybody's life. Right? Business operates in 5 to 7 year cycles. And those cycles are real. Like for example, I go and talk to people about private markets. They say, why would we invest in private market? Public markets are amazing. I say, boss, markets operate in cycles. Do you know that? Why does it operate in cycles? Because what goes up comes down. What comes down will go up again. So just know that the cycle will work through. That is very important to understand. End of the day, we are all taking risks. At some level in markets, we are all taking risks. How much you can be able to see through that and how deep your analysis is what will make the difference at the end of the day. Otherwise, I'm telling you, next day we'll sit here, you'll ask the same question, we'll be one more. We'll pick another country, something will be happening. So that's just the way of the world now.
So, yeah. Yesterday, in fact, myself and Naveen having a discussion, can we offer a course of this different? Can we offer a course of private equity? Is it an industry or how does the skills different for the particular
It's a really great question. Experience with private equity is quite new, as you know, when I was since I've been there. But I worked with private equity companies in my previous avatars. I worked with companies both in Australia and India. I worked with private equity companies. I worked with sovereign wealth funds. I worked with large family offices. So I've seen different types of asset managers as a whole. I think asset management as a broad field of study is definitely an interesting field of study. And I think of that with that I think public equity is in there, private equity is in there. I think it's becoming an increasingly important area. So for example, a large number of family offices in India and the world are now thinking, should we be managing our money differently? Right? Large pools of capital, even in family offices, they're saying, how should I be doing the analysis of my portfolio? What is the right allocation? How much in public, private equity? How much in real estate? How much in gold? How much in debt? So that's the full kind of. I think that is definitely an emerging career area. My only caution though is most of the people go there after some years in a prior field,
right?
Whether it's in banking. So I think it is more suited for a more not an executive management but a more advanced management type of course,
right.
Where you can get people who want to make a switch into that. Okay. That switch will come from people in investment banking, in consulting,
right.
Other lines of business, even the finance line,
right.
Who might say, listen, I like investing, I've been doing this, I've got a few years of experience, I understand broadly business and how it works. Now I want to understand portfolio. So I think portfolio allocation and understanding that is a great course. I think that there is a further line of study which is asset management, right. And understanding different lines of that. Within that, private equity as an opportunity is an interesting one to study. The reality is that private equity, there's only that many jobs available, at least in India. It's not a very deep, like in growth equity, there are maybe 10 firms.
Right, right.
Each firm has maybe 10, 15 investors. We're talking about an industry or a sector that has maybe 200 people in the country as investors. It's a very, very small space. So it may be premature to offer just private equity, but asset management, portfolio allocation, those types of topics, I think are very valuable. In fact, if I can go one step further, one of the things I often find very interesting of people in the north. In fact, this morning in one of my meetings, I was telling very senior gentlemen my learning from this. I've gone and spoken to lots of family offices across the country. I've spoken to family offices in many states, maybe 10, 15 states.
Right.
I find that family offices, people managing large pools of capital, especially the north and the west, are very savvy. They think of the money they make also should deliver a return. And like, I'm not generalizing, but I'm just saying I've met enough people, including I know myself and my own family. We think of the money we have made as we should preserve it. Bad luck, whatever. And there is I think something in there which is how do we think about our own asset allocation? How do we think about our own portfolios over time? Because I find that even people who are doing trading and equity are doing it to make a fast buck. Like they say, oh, it's like it'll be cool. I'm not talking about this, but I think in general, right? It's become, especially as markets go up, it looks great. Markets come down, it looks terrible. It's terrible. So how do you think about portfolio allocation, investing your own money? I think it's a vital life skill that frankly, I don't know why my MBA class didn't teach it, but every MBA class should be teaching that. Right. How do you think about portfolio allocation over your own lifetime? If MBAs and PGDMs don't know it, right, how can we expect the average layperson to know it? That is something I would absolutely recommend as a course.
Definitely, sir. Fine taking, sir. This batch is so functional, people know master class and very, very easy. Thank you very much. I'm putting him up, sir. Yeah, we can. Thank you.
It was wonderful to have Mr. Naveen Unni. I think students gain a lot interacting with them. As I keep repeating, we don't interact with people like Naveen on a daily basis. So thank you so much for sparing your time and interacting with the students. Maybe a final question you can ask?
Yeah, please.
He's been a McKinsey veteran for almost 20 years, completely different work culture. Yes. TVS more conservative, more laid back. Not to say that they are not aggressive, but very kind of conservative approach in terms of investment. So how did you really find the switch from McKinsey to TVS?
Yeah. No, it's I would say like a switch in three different ways. I think the sector, the industry switch is big. I think there's another sector switch in terms of the company, and there's a third switch which is the nature of the company also, which I would say, like you said, it's a very I don't know if it's conservative, but I will say that it's a very domestic company. I worked in the MNC, right? So my colleagues, 20,000 colleagues around the world. I could pick up the phone and speak to anybody anywhere. I worked for 9 years in Australia, right? My colleagues there were mostly Australian, and they're very, very different, very international to a very, very domestic, very Indian organization in TVS. But to be honest, the primary reason I made that move was because it is so Indian, right? So we, like the thing that we're trying to build was very attractive. To build a leading private equity institution, asset management institution out of India, out of South India, was the overall goal. Right? There are institutions, but how many are in South India? I'm saying South India because even if I take Bangalore or Hyderabad, we don't have private equity institutions of any scale. Second, we have a lot of private equity institutions that are global that have set up here, or other institutions that are set up here, but kind of a homegrown private equity institution that takes mostly Indian money and deepens the principle was a very meaningful thing. So I walked into this knowing this is my broad point, and that's also very attractive. Now to your question of how does it feel, it is a massive learning journey. And again, in our commencement speech today, I talk about that. But for me, this notion of always learning, always developing, always pushing the boundaries for yourself is very important, right? And so for me, that is the next. I always go on these S-curves. This is my next S-curve. And it is part challenging and part exhilarating. The challenging parts are to learn a lot of things on the fly. And a part of this is actually to apply all my lessons from IMA 22 years ago into this space. But it's great fun.
Wonderful. Thank you so much for it.
Thank you, sir. Thank you very much. Thank you, sir. Thank you.